All right. It looks like everything is running smoothly here. We're going to go ahead and start in just a moment. Just going to go ahead and send out a few notifications. All right. Let's get this show on the road. Thank you guys for watching. And thank you everyone who stopped by for the very first stream yesterday and showed your support, put a like, put a comment, and watched it. I actually got I was pretty pessimistic with how the first stream would turn out, and I was uh, thoroughly surprised actually with the amount of support I got. So thank you guys for tuning in and watching me ramble about these markets. Um, because of that, I'm gonna go ahead and do something a little special for you today. I'm gonna go over the monthly risks using pivot probabilities, and then go over a couple of end of day probabilities using the range probabilities indicators. Probabilities. You know, that's what we got to deal with here. I got the YouTube chat open, so if anybody is hopping in during the live stream, I can actually see them. I got some notes. The links for all those notes, all the things I'm referencing, are going to be in the description. And yeah, let's get right on into it. First, I'm going to cover the DXY and the plan going out into the end of month, and then cover the ES, and then I'm going to kind of go a bit all over the place. I'm going to be summarizing a bunch of the market outlooks that I've read that actually have further outlooks going into like the fourth quarter, some Bank of Japan stuff, some new expectations for actually growth and recession. So there's a few things I want to pull up and have us look at. So the DXY. Obviously, you can just look at this chart and you can see the probabilities based off of where the top next month typically occurs between any of these two pivots. And these are probabilities just for the month of June, so they're seasonal. So this is saying 26.79% of the time the top for the month of June on DXY occurs between that R1 and R0.5 monthly pivot point. And that's roughly, well, not roughly, it's exactly in this range between 104.35 and 105.46. Now that's quite a big range, but we still got a couple of trading days here left before we get into June, so we can continue to move higher. We effectively can just have a continuation trade from here, and my baseline expectation is that we'll probably head to that probability weighted pivot at 105. We'll probably reach 105 most likely, going sometime into next month. Now, if we do it sometime in the first week, it's going to probably be purely a momentum move. Because there's this other indicator you're seeing on the screen with that table in the right-hand corner and these funky bars that get projected out in the future. This is another indicator I built called seasonal forecasts, where it tells you the expected value, the historical expected value by the trading day. And you can very simply break down like, okay, if this trading day has very bullish expected value, it's going to be a very good sign that to either review events that occur on that trading day to make sure you don't get sidelined by some major macroeconomic event, because typically you can run into some big problems when you have, like, if one of these candles have big up wicks and down wicks out into the future. Well, that frequently happens when those bars land on an FOMC day. Now, these bars in the future, they're small and they go sideways. They don't really give all that much information. So that tells me it's pretty neutral. Like, the seasonal forecast here for effectively the rest of this week and the first half of next week is sideways. Like, not a whole lot of fantastic information. You got a little bit of positive expected value today and tomorrow. And then on the second trading day of June and the fourth trading day of June, you have some negative expected value on those trading days. But on all the rest, you see the expected value is close to zero. Pretty flat. So the seasonal move isn't particularly strong going forward into the next week. So not particularly helpful to try and rely on some seasonal indicators, frankly. Momentum wise, we can pull this up. This is actually something new I actually learned about last night. This is the MACD with volatility normalization. It doesn't look like it's giving any signal right now other than that, hey, you're increasing and you're continuing to increase. And this is actually just, if I remember the trading rules correctly, just broached the value threshold where if you're a bull, you can actually continue and do long bullish continuation trades from these values. So that's that. And M oscillator is in overbought territory. So you would be holding on to your longs. Man, it's almost like I make videos for a private group or something that was saying to buy down here at the beginning of the month or whatever. Oh man, who knew? Who could have possibly known that 35% of the time your low for the month occurs roughly in this area right around here? And you're at a psychological support of 101. Oh, the pain. How unpredictable. I know I'm kind of being a jerk when I do that, but I've been now trading this thing for like 3 years, so you do this enough times and it kind of gets boring. I mean, personally, I do all my analysis in about an hour. But yeah. And also looking at next month, I mean, eventually, I anticipate at some point we'll go below the monthly central pivot. I mean, if I had to guess how we would move through DXY going into this next month, it'd be like up for the first so-and-so weeks and then down. And I could leave these arrows up and I could timestamp them. So let's do that. 2023, 05, and what? 29? Oh. 29. Oh, it looks like it says YouTube's not receiving enough video to maintain streaming, such as buffering. Okay. So we got a little bit of a technical issue. Let me go ahead and try increasing the bit rate to like 6,500 kilobits instead of 5 kilobits. See if that resolves YouTube's hunger for my data. Hello, Clemenci. Hopefully I said that correctly. And hopefully you heard me. Hopefully YouTube isn't garbling it up. Let's go ahead and timestamp this one. Cool. YouTube is now saying that the stream is healthy and we're all set. Thank you, YouTube. So that's the expectation for DXY for the whole month, which is pivot probabilities wise this is super straightforward. The other thing we can do, at least right now for the day at the moment, is go to a 1 hour, and I have this especially set up for us here on the stream, is to look at the range probabilities here for the day on a 1 hour chart. Oh, it looks like it says YouTube's not receiving enough data again. Well, sorry YouTube, I can't help you this time. You're taking all my data. Yeah, these are pivot points indeed. This indicator right here is in fact pivot points. And then the pivot probabilities is the other thing that I was showing. With those odds that helped me forecast the 105 for DXY. And those are some pretty good odds that we go to 105. I think it was like, if I quickly refresh myself, I believe those odds were... So real quick, what's 14 plus 12 plus 2? Let's say. It's 28. So, rounding, let's just say it, instead of 20, it's 30. So 30% for the month over the last 60 years of historical DXY data that we have. 30% of tops for the month have occurred roughly in this area right here. So this implies, okay, well 70% of your tops are going to be above this price, above this R 0.5 level. So from here, this is your 70%. Now, that's a lot of range for 70%. Obviously, we kind of want to round down, right? So I'm saying 105. Give or take this area here as quote-unquote valid. And if you want to get super specific, the whole 5 range is right around here. Oh, I'm just constantly clicking on drawings, and TradingView won't let me get my measuring. There we go. Right there. So this is your whole 105 range. And yeah, I think that's quite likely to get hit, especially based off how highly autocorrelated and how high the momentum is right now on this. Yeah, look, some people are going to be... I already heard one person send me a message saying, hey, look at this. You're at a resistance, my boy. You're not going to go any higher. Look at the resistance, man. The resistance. And I'm like, the momentum, man. The autocorrelation, man. Just because there's a price with a line in the sand that you drew does not mean tens and hundreds of millions of dollars are not going to try and break through that. There are greater reasons for an asset to move than just the lines you draw on a chart. That is to say the least. Hey yo, Princely. Nice to see you, my man. So, that is DXY to 103. I think we have fairly good odds there. Now for our odds of where we're going to end up closing right now for the day, kind of our probability range on that. Now, this is the daily plan. That's what the show is called. So let's go ahead and do the daily plan here. So on range probabilities, we got all these different settings. And this is looking back 5,000 1-hour bars and creating this probability distribution of on a higher time frame, daily time frame, where does the day usually end. I real quick want to check how far back 5,000 bars is. Real quick. Much data. Yeah. I think I only want 3,000 bars here. Don't get me wrong, that's still a lot of data. But I think for how price has been behaving recently, I just want 3,000. And yeah, I think that's actually going to help in my interpretation here. Yeah, resistance, man. Resistance, man. Yeah, so when it comes down to where we'll likely end on the DXY today, I'm going to put my line in the sand. And actually, I'll show you this. Look at these tooltips here. When you hover over, so these probabilities that is showing you, it's drawing a bunch of bins and it's randomly sampling from a probability distribution and telling you, okay, well, here's your actual odds of getting the close for the day between these two prices. And you can hover over these little tooltips and it'll tell you, okay, here's exactly the probability. First off, that very first row is your probability of closing specifically exactly between these two prices. Then the next one is your total probabilities above a price, and then your total probabilities below a price. So right around here, we get our 50-50 line. So rough around here, and I'll go ahead and make this line big. 50% of our probabilities are roughly above this line and roughly below this line. So my expectation right now, this late into the trading day, is I have no reason to believe the dollar should go down at this point, looking at the higher time frame, macroeconomically, looking at the research, and looking at the statistical distribution here. I have no reason to expect also. You can just look at this bump right here, because you can visually look at this distribution and just see this histogram like, oh yeah, this is big, right? And then when you go and you look at the actual data over here, it's like, yeah, when you see bigger bars here, that's a bigger probability. So this is a smaller probability. This is a bigger probability of where we'll close the day. So based actually off where we are right now, I'll get even a little more aggressive, right? So see this line here? This is like a 40-60 line. So this is saying 60% of the time you close below this line, 40% of the time you close above it. I'll get even a little more aggressive and put my line right there. So tomorrow, when I do the daily, the daily plan, these daily streams, I'm going to go ahead and check. Oh, did we get this right? Did we close above this line? And I don't know yet. We'll see. But I have a feeling we'll probably end up, based off how we're currently trading, we made a higher low, maybe we'll make a slightly higher high. I'm also expecting that we'll probably close in this juncture right here. And this is just a total guess, right? But it's an educated guess with some probabilities. So let's move on to the next headline topic, the S&P. And I like to use the ES. And real quick, let's do the daily plan for the ES. And I think this is pretty straightforward, no? Like 77% of the time, you close the day above this 42.19 level. So what I'm going to do is, or rather, place my theoretical bet right here. Because, what's it? 77% of the time, the close for the current trading day is above that line. Like, that can be so stupid simple. And you know what's kind of cool about the way this distribution is modeled? Look at that. If you were just using a normal distribution, or, I mean, like if you're using any cookie cutter distribution and pulling random samples from it and trying to model financial prices, it'll do an okay job. But there's no statistical distribution that's going to give you that. This little bit of tail right, like it suddenly jumps right around here like, hey, you get a lot of your closes right around here on the day for some reason. This is a bit of important information to have. Same closes for the day occur right around here. So that's all well and good and useful. But let's move on to that $4,300 projection on the index, right? So let's turn this off and go back to the pivots and the probabilities. Oh, and check that out. We hit the probability weighted pivot high for the month. I wonder if we hit the low. Oh man, we hit the low. We hit the low, guys. Oh man, we hit our targets. Fantastic. Now let's try our best to do it again this next month. I mean, this also looks incredibly obvious when you look at this and you're like, where's 4,300? Well, if I could real quick get the fancy drawing tool, this price label thing here, and pluck it down right at 4,300. There it is. So area right here is kind of your minimum target if you're just arbitrarily shooting for 4,300. But let's think a little harder. These numbers right here add up to 52%. So just in the month of June, for at least the last 20 years, the S&P occurs right here. Between these two pivots, R2 and R1. 52% of the time. So, unless we believe one of two things, which first is we right at the open for the month and immediately start heading lower and never go above 42.50. We immediately reverse, but that occurs only about 12% of the time. And that prior situation where you open the month and you top out right at the beginning of June, that happens actually fairly frequently, almost a little more than a quarter of the time. Yeah, Clementia. The guys in my trading group get it, but they also get the pivot probabilities and a few other things. They get quite a bit of things. The link to that's in the description of the video too. Yeah. But when it comes down to this segment here, I'm not totally sold on this. Just you open and go down, you go a little bit higher and you go down. My basic with these probabilities expectation go to somewhere in between R1 and R2. So how about we draw another set of arrows, or at least one arrow, or I say we go up. Now, how about I also look at the seasonal forecast? Yeah. Oh, isn't that super clear? I think it wants me to buy the thing. Oh, man. Well, one thing is tomorrow you get some bearish expected values. Yeah. And check that out. Pretty flat, slightly positive expected value during the first week of June. Not as positive as these median return bars look. But the expected value is still respectful. Yeah, so that looks nice. Maybe we get to 4,300 in about, call it a week and a half from now, by the end of next week. And I'm not talking about the week we just opened being referred to as next week, right? We're in week 22 of the year. I'm talking about the end of week 23. All right? Yeah, week 23. Okie doke. So that's that for pretty much the month. We could make a trade plan for maybe where the month will likely end using this indicator, where the month is likely to find the low using this indicator. But for now, let's move on to the actual work here. So I'm just going to leave this chart like so we can just watch it. But I got a slew of notes here to go over macro-wise, because there are some major developments going on in the field of economics right now when it comes down to future expectations for central banks, economics, and then also a couple of things for this week on the economic calendar that I found interesting, right? Everyone's going to talk about NFP, right? But I think just someone saying like, oh yeah, NFP is probably going to show up pretty all right, I don't think totally captures the picture. Let's see here. Bum-ba-da-bum. There we go. So you can see my notes here. That's what I'm going to be reading here. And the links to all that stuff is in the description, right? Now, that might have looked like a lot, but that was maybe just like 2 hours of reading and watching videos, and I was writing these notes as I did that. And that pretty much informed me about all the macroeconomic information that I would need to know for the next 2 months. That's a huge ROI on the time you spend. Yet, so few people who want to become serious professional traders will ever spend the time to actually listen to what professional PhDs who write free outlooks on a weekly basis, or heads, senior economists, heads of research, some of the most powerful men who run the wealthiest banks in the world have to say about their country's central bank for like a paragraph or two. Like, oh no, I can't spend the time reading that. Give me a break. So I'm going to read some of it to you guys. Very abridged and very short. Like literally some of the stuff is like 2 sentences long, and then I'm on to the next subject. So, real quick. First off, for the economic calendar, and I think a good chart to have on screen right now, the ES is a good one when talking about this, because the economic calendar is very US centric right now. So first off, global and US manufacturing PMIs are coming out on Thursday. And if those continue to slow, it's going to be adding fuel to the fire to the people who think a recession is going to occur. And that happens on Thursday. Alongside that on Thursday, there's the Eurozone inflation and unemployment. Yeah. Eurozone, inflation, and unemployment, you gotta watch it if you're going to be trading anything Euro related. Let's see here. I believe, here's the Euro stocks. So this is the European index. This is their equity index. And it's been going sideways. It's been horrible. I mean, just compare it to the ES. Let's see. Here's the ES. The S is up 3%. And the stocks is up 2%. 2.5%. You know, it's not a big difference. It really isn't. Effectively, both of these things have moved sideways. But one is clearly weaker than the other. So, not good. And if inflation keeps coming in hot and unemployment keeps rising, you know, I just got some outlooks saying that European inflation is going to go back to double digits sometime in the next 4 months. You can't have that as the ECB. The ECB is effectively going to get shoved into a corner to hike a few more times if that's the case, and it'll shoot unemployment higher and higher and higher, and it'll stagnate the European economy more and more and more. And all the guys for the last 3 months who've been calling for euro dollar to go to 105 are going to get their wish. Now, the last thing, economic calendar related, that I want to mention, right? Non-farm payrolls, U.S. unemployment. Higher non-farm payrolls is more likely for the Fed to actually hike their rates at the next meeting. And I think right now the consensus expectation is for payrolls to either slightly increase or slightly decrease. It depends on actually who you go to for what the consensus is. But I'm pretty certain that once we get like into Tuesday, into Wednesday, whatever the Bloomberg consensus is going to be what everyone says is the consensus. So wait until maybe later today or Tuesday to get the actual consensus number. However, there's a serious problem with NFP. Serious problem. Because I don't know if you guys have short-term memory or not. I don't. And I bet you guys don't. Because you guys probably were trading this. NFP, the last one, it had massive revisions for January and February. Well, also, I think the last one had revisions specifically for February and March. So, because those revisions were so big, it's genuinely not out of the question that we see further downside revisions when NFP comes out again. It's not out of the question. That has to be a part of everyone's analysis, yet I'm only seeing like 2 or 3 people talk about it in their outlooks, which is kind of ridiculous, which puts a lot more pressure on the Fed to pause. Because if NFP comes out like super positive, super high up, right? What did I just say? If NFP comes out higher, then the Fed's going to be more likely to hike rates. But if that also is coincided with revisions, downward revisions of, let's say, February, March, and April, again, that's going to change the entire interpretation, because people are going to think, well, crap, are these numbers going to get revised too in the future? What's going on with these numbers? Can we actually trust these numbers are representing the economy? And the Fed's going to be more inclined to pause based off that super mixed information. It might seriously discount using that information in its decision to hike or not. So, speaking of central banks, I was watching Henry Hugh. He thinks the Fed should pause and that they're starting to behave cautiously about pausing. The truth is that if you actually follow the individual Federal Reserve members, right, the FOMC committee, and you follow what each individual member is saying, you'll know like a little more than half of the members really would prefer to just pause right now. But Powell is still in the more aggressive camp. He's still the leader of the pack. They want the FOMC to have consensus. But again, if you get that mixed NFP, you're probably going to get Powell to concede and go on to the side of caution and at least pause right away. There was an outlook by Moody's in their weekly outlook. Says that the Fed is more likely to be over tightening monetary policy, and that tightening right now at its current level could cause liquidity problems, which could flow into a new banking crisis. And that's the first time I've heard that put like so dramatically, banking crisis. They're Yeah, let's see here. Moody's also did a big survey of professional economists. Oh, I got a screenshot of that. Oh, good lord. All right, check out the chart. I can put screenshots on the chart. So this comes from Moody's. So they did a survey specifically of professional economists, economists who were staff at the Federal Reserve, bond investors, and some CEOs. And they asked them, all right, what's the likelihood of recession occurring sometime in the next year? And what they said was, oh, well, most of the people said it's like 50-50, 50-60, right around here. And most people lie in this range of 40 to 70%. And that sounds about right. But it also shows like, oh, there's actually quite a decent degree of uncertainty as to whether or not people think of like a recession is going to happen or not. Like things are kind of tiptoeing whether or not we get it or not. And frankly, I'm in that camp too, because while a lot of these institutions and outlooks are making claims about how like the next 3 months are going to go, I've been around for long enough to read outlooks and forecasts that tell you like, oh, this is what we're anticipating and expecting. And then the exact opposite occurs simply because whatever trend was anticipated, just the exact opposite happens. No, sorry, that was a ding on my end. Turning off the desktop audio. Yeah. Westpac and ASB. And now we're talking about the RBNZ. So real quick. Here is New Zealand dollar. And I caught the top of this. And I caught that one down. This was phenomenal trade. And you can see why. Probability weighted high, caught that. However, here's really why I was short. Look at these probability weighted pivot lows. Way down here. So when we here and higher, I'm like, oh my god. The probability somewhere down here is like 86, 87%. I gotta be shorting this. I gotta be shorting this whole area. And boy, oh boy, did that pay off. Westpac, the largest bank in Australia, and ASB, in both their weekly outlooks, say there are significant upside risks to the Reserve Bank of New Zealand's rate path. So both of them think at least one more 25 basis point rate hike is going to occur, and that's it. The Bank of England is expected to hike rates after the UK CPI came in hot last time. And man, has it been bad. But man, have the probabilities been on point this month. And out of the question just to see you do a continuation to 222, to 122. Find your low, a likely low down here, and take that high. You guys are getting some extra analysis here. We got a guest on the show. Say, we do a good girl. You's a good girl. Alright. I won't be long. Let me finish this up, little kitty cat. Yeah. Yeah, thank you guys, yeah. So, one thing about the UK, I actually got like 3 special reports on the UK and the UK economic system and how like inflation is totally screwing over the UK and how they're gonna hike in a way, right? Wells Fargo did like a special report on it that was particularly thorough that I recommend reading if you need to educate yourself on the macro of that side of things. But just blanket across pretty much every outlook that I've read that even briefly mentioned the Bank of England or the pound or the UK economy for like even just 2 or 3 sentences at minimum, which is like pretty much every report I read. Yeah. 25 basis points in June, 25 basis points in August. And the rate hike probabilities keep going up and up and up for at least 25 after that last CPI release. And that's it. I mean, it's not really going to change much. You got pretty mixed seasonal expected value up until maybe like effectively the middle of a week and a half from now. So I don't think the trading is going to be particularly fantastic on the pound. Not at all. Let's do the range game. Let's try and figure out where it closes. Huh. Aw, poor indicator. Timed out. Well. Wow, it's already, so it's got kind of a bearish skew to it, so. I mean, I'll just put my line below highlighted right now. And I'll make my line kind of like this whitish red color. There you go. That'll be my little threshold line. Although I'm kind of 50-50 on whether or not we'll actually close above that, in all seriousness. Even though the odds say it's more like 60-40. Playing a little game here with those forecasts. Yeah, actually, you know what? I do have one thing about the Bank of Canada. And out of all the people who actually talked about it, Wells Fargo was the only one who brought up Bank of Canada. Wells Fargo sees that the Bank of Canada is going to probably hike more in the future. There's more risks that they actually hike in the future. And they've updated their forecast for the Bank of Canada to start hiking out to start cutting their rates in 2024. Originally, they thought they were going to cut rates in the fourth quarter here, but now they've moved those rate cuts like way out. And the last thing, central bank related, I know I'm like dozing off here. But seriously, it's like, this is a 5-minute segment. And it's all the central bank news you need for like the next 2 weeks. all the shows are going to be super short for the rest of the week here. I'm getting all my macro in now. Joe, why didn't you go over any analysis on that economic event? Well, because I already did it 4 days ago. Send people a link to this stream. So the last thing for the central bank part of this macro talk is BOJ. And man, doesn't that look bullish on a 1 hour? Well, I'm about to blow your mind. Pow. Now, you want me to really blow your mind? Like, something nobody else has? Another fancy little schmancy indicator? Do the glasses nerd thing, right? Check this out. FX yield spread curves. Let me put on the cool experimental one. All right. Now we just got to get it to load up. There we go. And look, it changed all my bar colors. So these are yield spreads. And all you need to know is green means you're likely to continue going higher, and red means you're likely to continue going lower. So look at this and argue about whether or not it was right or wrong. I mean, like green, emerald green, and is not letting off the gas. And then back here, red, and like ruby red. Green. This is dummy simple. This is a dummy simple indicator. And you can make it also dummy complicated. Right? Because now you're looking at yield spreads across different lags, across all the different yield durations. Like, if you know what yield spreads are and their importance to how they lead FX prices, you know, of all the quote-unquote leading indicators out there, this is probably the only one that has been a documented and known factor as a leading indicator for the FX currency market, for pretty much every single FX currency market out there. Not like, oh, this is a technical, indicator that sort of works on things when it likes to. It's like, no. Yield spreads are a known leading macro effect on all currency pairs. At least all the currency pairs that I care about. And this thing has saved my ass so many times. And by the way, people have been using this indicator for decades now, for at least 30, 40 years. Like, people have, I would argue, people who have traded billions of dollars have traded using yield spreads on FX. I would bet someone has done that. Absolutely. Considering how long this indicator has been around and considering the forecasting power of it, yeah. Abso-freaking-lutely. So, with that little bonus tidbit, there's actually some critical information about the BOJ, and we have a massive change in expectations about the BOJ. I was actually just talking to somebody last night about this, and it was, I was autonomously thinking like, based off all the information I'm seeing macroeconomically, all the data and the whatnot about inflation, and how the Nikkei is going so high and how the yen is devaluing so much right in front of us here on this chart. I was like, isn't the Bank of Japan going to do something? They just changed their governorship, and they flat out told us they're not going to tell us when they do their rate hike. They're not going to give any sort of preparation for it. They're not going to telegraph it at all. Maybe they do a leak in the Nikkei, right, which is like the Japanese version of Bloomberg. So here's what my note says about it. Due to Japan's continued rising inflation, yen exchange rate devaluation, and meteoric rise of the Nikkei index, right? I think that the BOJ is going to hike rates sometime this year in an untelegraphed surprise move. And the next part of my note is just literally something I added like last minute. The only outlook this week I found with exactly the same sentiment that I had was from Wells Fargo. And they actually have a time frame. They have a specific month. So they have exactly the same expectations as that. But they're expecting the BOJ to announce that their surprise hawkish policy in October. And I hope like the few people who get this far in the recording or are watching the stream live remember that fact and try and remember it well, because every single pundit, by the time August rolls around, October, right? By the time August comes around, everyone is going to be talking about the surprise BOJ hike that's supposed to be coming, right? And sometime around August, the yen might suddenly start getting stronger. Like, these are important things to keep in mind. The change in trading expectations here is occurring right now this week about the Bank of Japan in a very serious fashion, where traders are now starting to potentially bet, hey, BOJ probably going to hike sometime around the fourth quarter. Yeah, that absolutely could be too, right? They could do that in July as well. And personally, James, if I was at the BOJ, I would do July too. Then again, I don't know how much in depth I can go into this because it's like super nitty gritty stuff, but I was reading an outlook, I was reading some research, and they were saying specifically, the increase in rates at central banks is increasing the rates at which loans have to be given out. What is it? The yield, the price you have to pay for the bond, right? The rate of the loan. And that somehow that is increasing inflation. Obviously, I didn't read into it too much, but I believe the key phrasing of the argument was when you increase the cash rate at a central bank, you don't just decrease the supply of loans, you also are decreasing the demand of loans. So you're just bringing aggregate demand and aggregate supply together lower, and the money gets spent elsewhere. And I'm still thinking to myself, how does that make inflation rise? But I was reading that argument, and maybe I need to reread it again. And hopefully I didn't just confuse you all, but it's kind of one thing that's stuck in my head. And if you want to read that outlook with me in the Plan to Profit Discord, maybe help me figure out like the deeper meaning or the deeper interpretation of that. Links in the description. Hop in the Discord. Or if you're already in there, you're most likely already in there. But yeah, that particular outlook, that particular bit of research kind of threw me off. All right. Let's get into the economics segment here. I got a picture here of flash PMI output indicators from the G4. And I got another picture also of flash PMIs, but decomposed into the actual G4 countries. So bring the front, so the chart, isn't in front. So S&P Global PMIs, for the first time in 13 months, are showing the fastest economic growth in specifically the G4 countries during this May. Now, specifically, the G4 countries are the US, Eurozone, UK, and Japan. Just mind that. Growth. Let me bring up my chat. Oh, yeah. Yeah, definitely could gain on that BOJ news for sure. But yeah. One of those factors actually in the BOJ decision is this. How growth turns out in Japan. Now, growth is slowing in the UK and the Eurozone, but it's still going up in the US and in Japan, and especially manufacturing PMIs in Japan. That's this little teal line here, and I don't know if you can see that, so I'm going to blow it up here real quick. This line right here, the one that's going absolutely vertical. Yeah. And then your services PMIs are all generally rising, except in the UK. However, on aggregate, the G4 PMIs look like this. The services and the composite are all doing well, but the manufacturing is still shite. Alright, in a bit, Turnball. Thanks for watching, my man. It's cool when I got a low viewer count right now. Man, it's going to be... chat's going to be so hectic once I get like 30 viewers and everyone's telling me, oh, please pull up a chart. Like, obviously you don't know how I do my shows. We do macro, we do a few really good trade plans, and then we'll do it again tomorrow. I'll get to it sometime this week. If you want me to look at something for you right now on demand, one-on-one with these indicators, I'll just show you how to do it yourself. Join the Discord, right? Buy the indicators, join the trading group, whatever. Just let's get you what you want, but you're not gonna force me how to do my show, man. And I'm only saying that now because I know like a lot of people who've quit trading YouTube now, and I know if a couple of my trading channel YouTube guy friends see this, they're gonna be like, "Oh, he was talking about me." Like, nope. There's probably like 3 other guys than you that I know who've also stopped. And you know what? Like the number one reason why small finance trading YouTubers stop. The number one reason that I got from a survey of a total of 5. And by the way, all these people had more than 4 figures in subscribers, by the way. The number one surveyed reason for stopping was, drumroll please, stress and trying to be too responsible and too focused for other people's decisions. Thankfully, I don't give a crap enough unless you're paying to use my indicators and I'm teaching you how to use and interpret the indicators, right? I'm not gonna tell you what to do with your trade. I'm gonna look at the probabilities and determine what to do with the probabilities. How do you interpret these probabilities? What are the risk thresholds and whatnot? However, to put that all into context, to actually understand how to approach and interpret those statistics on an asset to asset basis, you have to understand the freaking asset. You have to know what you're freaking trading. You have to read the outlooks, man. You have to read the outlooks. And yeah, going through this stuff, we're plowing through it. I mean, for example, a really, really good thing to know is the dollar smile. Here, let me pull it up real quick. I was talking with someone about this yesterday. So, just looking at those PMIs, right? The PMIs are going up, 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 and away. So we're getting increasing growth, but we're also getting a decrease in inflation, right? So first off, looking at the dollar smile, the first thing to note is growth in the United States is growing faster. Growth in the United States is larger than in the other G countries. So we're on the right side of this dollar smile here. The rest of the world has some slowing growth ahead, and the US is still growing, and it's likely potentially going to outperform at least over May is the expectation. At least over June is the expectation. Now, here comes the next part. So growth in the United States is high. Growth generally across the world is doing all right. So the US has a bit of a leg up growth-wise on an absolute basis. But on top of that, inflation in the United States is also decreasing faster than inflation in these other countries. So not only is growth going faster, the inflation is falling faster. Now, I don't know how many of you guys have heard of a growth inflation matrix, but it looks a little something like this. So you understand how like so many people are shocked that stocks are doing okay, right? That high yield, right? High yield hasn't totally plummeted and taken a complete nosedive. It's making higher lows. Don't get me wrong, it's making lower highs, but it's consolidating. Now let me get back to that chart. So if inflation falls fast enough, like seriously fast, and for example, we know expectations for European inflation, it's like one of the very first things I mentioned on the economic calendar, right? Oh man, it was so long ago. The economic calendar on Friday, Eurozone inflation, unemployment, right? Inflation expectations in Europe are still elevated to the point where I'm getting people saying, oh, we're probably going to see higher inflation. We're going to see double digit inflation in the Eurozone again sometime in the next 4 months. People are very aggressive on the amount of inflation that is coming out in Europe. Just as a frame of reference. So the United States slowing inflation faster than all the other G countries, rising growth faster than all the other G countries. You're here in this bottom right quadrant. And this is identifying, oh, here are the particular assets that do well in this economic regime. And this is a style of portfolio management that's been around at least since the 1980s. In the description of this video, there are 2 links. There's one by a guy named Brent Donnelly. I recommend you read that. And there's another one from PDM, or PD Macro. And it talks about the history of how the growth inflation framework came to be. Understanding how to interpret and when a growth inflation matrix could actually be useful to you can help make some decisions stupid simple. Now, in that quadrant, we were looking at, it said stocks do well, but there's other quadrants where stocks do okay. And what you need to understand is that you have to break it down by equity, and these are US equities. So I know this might look a bit fuzzy, but just look at this real quick. So we're looking for the section that says faster growth, slower inflation. And on this growth inflation matrix, the way it's oriented, the thing that we're looking for is in the top left. And look at usually what performs the best. Technology, consumer cyclical, communications, healthcare. Now you tell me, if you've read any financial news at all, what have been the top performing sectors for like the last 2 weeks, at least. It's been technology, consumer, communications. Like, this stuff can get brain dead simple when you know what information to look for. And if this regime continues of continuing to see continued growth, continuing to see lower inflation, you'll continue to see these sort of returns more likely than not based off this historical growth inflation management and matrix. That's just how Will that be due to China's growth? China is making their own planes. No. Um, when I was watching that Hugh Henry interview, it was one of the first things I mentioned. Hugh Henry mentioned, oh, um, have you seen the amount? One of the things that China's been doing to hack their GDP is they've been building like an insane amount of pointless bridges. There's a chart of like the number of bridges in China, and it just goes up like an exponential function, just up and away into infinity. No, the growth in China is expected to slow. There was a big outlook by Morgan Stanley that really tilted Wall Street, to say the least. Where Morgan Stanley was saying, yeah, or was it Goldman Sachs? I forget. One of those two. Although I really shouldn't be confusing the two, to be frank. I really shouldn't be trying to confuse the two. I haven't jogged my memory about it. But they're threatening to reduce their GDP forecast for China. And a lot of other firms already have much lower expectations for China. I mean, I can tell you one thing. The steel output of China is at like some multi-decade low. That doesn't sound like a good setup for higher GDP. So China is probably going to have a regime that actually looks like increasing inflation and slowing growth. China is more likely sometime later this year to go into a stagflationary regime, increasing inflation and decreasing growth. China economically is in a pretty bad spot. It's going to be pretty bad. And that, frankly, is also the consensus. So just to repeat those growth inflation matrix references, those are all in the description. Let's see here. In the equities, yeah. Further out into the fourth quarter this year, S&P Global said in their weekly outlook that recession seems to have been avoided for now, but there's a very strong possibility that economic growth slows later this year. So the other thing on that point I want to mention is, while right now we could be in an increasing growth, decreasing inflation situation, we could have this sort of delayed recession where sometime during the fourth quarter, it almost, and it's not like one or two outlooks, it's like been 4 or 5 outlooks now that have all said, oh, we're expecting this fall in growth to occur towards the end of the year, all of a sudden. If you have significantly falling inflation by October, and then you're getting a plateau in your growth by that point in time in October, you could have a horrible fourth quarter. Like, that could just be red month into the end of the year. That could be a very, very bearish Christmas this year, if that's the setup that actually happens. Not great. Last part, Wells Fargo, they released their monthly International Economics Outlook. I mean, look, if you've listened to me talk about outlooks and go over some of these charts and some of these trade plans for like an hour and 20 minutes now, do one thing for me and read this one outlook. It's in the description. It's probably at the very bottom, actually. It's the International Economic Outlook by Wells Fargo. It's very comprehensive. It's actually quite long. But if you want to get into reading outlooks, try reading that, because that'll get you up to speed on a lot of parts of the global economy, like that, and also on future expectations. So it'll catch you up on some history, tell you what's going on right now, and then say, oh, well, here's what we're thinking as Wells Fargo going out into the future. And I think that gives you all the information you need to have some baseline expectations to work with to start when you go read other outlooks or talk to other traders. Start having something to some stable data to start making comparisons with other traders and other trade plans. And then you do that often and often and often enough, and you'll be able to eventually have your own autonomous trade plans, right? Now, what Wells Fargo specifically said in that monthly outlook is that they see the situation with higher growth, low inflation, but just like with Danske Bank and S&P, they're also saying like, hey, around the fourth quarter, we can see this negative shift in growth, which is not particularly great. And Wells Fargo is cocky enough just to flat out say, yeah, we are still expecting a recession sometime this year. We are still expecting a recession this year. That's absolutely on the table. That's Wells Fargo. And I think I did misread. Yeah, I do have one more thing. One last thing. Danske Bank, they had a yield outlook. I didn't put a link to it in the description. Sorry about that. You can get it in the Discord. They anticipate that the Fed, they actually have some timing about when the Fed will do their first rate cut. And I know there's a lot of people trying to speculate when the Fed will do their first cut. Danske Bank does anticipate the Fed's first cut to come in the first quarter of 24. And I agree with them. And their reasoning, their primary point in reasoning, is that the Fed usually has their first rate cut roughly 3 quarters after their final rate hike occurs. So if their final rate hike is here in June or July, then you anticipate, okay, sometime around the first quarter or the second quarter, you can get your first rate cut. Roughly 3 quarters from when the final rate hike occurred is historically how long it takes for the Fed to react with a cut. And if you think about it, if all of these institutions and banks and research firms are anticipating high growth, low inflation for the third quarter to transition into lower inflation and plateaued growth by end of August through October, and then rotating that into plunging lower growth with like absolutely flatline inflation. Now you're talking about like, oh, suddenly those expectations for when the Fed to cut rates in the first quarter start to make sense. Because effectively, now the consensus is getting moved from, okay, we're going to have our recession in July or August, to we're going to have our freaking recession during turkey dinner, during Thanksgiving and Christmas. That's what these bankers are now telling us in these outlooks, in their expectations. Like, that's going to be horrible. And FYI, just because global manufacturing is, down the toilet right now and new orders are going out the window, if there's a specific electronic product that you wanted to give someone for Christmas or for a birthday sometime in the latter half of this year or the first half of next year, you probably should buy that now. You probably shouldn't wait until, shit hits the fan. You should probably buy those electronics now if you want to intend to give them as gifts, or you want to have them, like, you intend to have those electronics for like a couple of years, because who knows what might happen to the supply chains again if there's a global recession during Christmas time and no one's able to get their orders through, and too many people are poor or hurting or starving or dislocated or homeless. Like, it could take an economy a whole year to recombobulate itself properly in order to give you your iPhone at a suitable price, because the supply just got cut in half, right? Although one reason why Apple's made so much money is because they've had like bulletproof logistics and supply lines. And frankly, one of the good things that's come out of COVID is now there's a whole slew of people who specialize in supply chain security. And I have a feeling that if this next recession does occur, when these institutions are saying, fourth quarter, during your turkey dinner and Halloween and, Christmas, that some of the people who learn to do really good supply chain security and logistics management as a result of seeing what happened during COVID are going to have their first opportunity to show off their skills during the next recession. And the people who do the best job are going to get hailed in the financial media and in the news as like, hey, look at how well these guys have managed these supply chains and these logistics based off of the things that they learned from COVID and that they've hardened in these chains since COVID. And I think those will be some actually really great stories, but man, recession in the fourth quarter, and then the Fed cuts like a month and a half, 2 months later, after a lot of the damage is already there. I guess one more thing I can add is a lot of institutions have already said that they expect in 2024 for the Fed to do their rate hikes. But I wonder if you guys know, like, by how much, right? And generally the consensus number I have is 250 basis points to 350, somewhere in that range. The consensus for how many basis points the Fed is going to hike over the span of 2024. I think it's roughly 250 basis points right now, a year from now, if I'm not mistaken. So, those are all of the freaking macro notes and stuff. I mean, now it's been an hour and 30 minutes that I've been going at it nonstop. I think I've had pretty high energy throughout most of this. My cadence has been pretty okay as well. I tried just to cover things that I want, and I know the show is only supposed to be like 10-20 minutes, but I just read a ton of weekly outlooks. I'm like, let me just write up some notes, see how much I can get done. And this is only the second daily plan stream. And over time, I'm going to get better and better at judging how long these streams should be, what kind of topics I should cover. So I'm going to try a lot of different things and see how I like presenting and in what ways I like presenting. And then I'm going to go from there. I mean, right now, I actually liked talking with James and Prinz and Cole. I like talking with you guys in the chat. You've asked good questions, and hopefully, I've given you some satisfactory commentary on the responses to those questions. Yeah. I think this was at least an improvement over the last stream. However, one big knock. The stream's an hour and 30 minutes, right? The stream is way too long. But in all seriousness, I think one exercise I'm going to do is I'm going to try editing this down. I don't know if I'm actually going to do it. At someone maybe ping me in Discord in like 5 or 6 hours from now and say like, "Hey Joe, do you actually want to do this or not? Do you want to edit down the live stream?" And in all seriousness, I probably will, because this thing is long as heck. And I make a lot of points in it. It'll be good for me to review and rewatch it again, Now I'm just making excuses on why I should rewatch it. But for you guys here who are still around in the chat, if you want me to go over any one specific chart, you can ask me to go over a specific chart, and I'll go over it with the pivot probabilities and the seasonal forecast and all the fancy tools, and give you a trade plan on an asset for the month. Otherwise, I'm gonna peace out. I'm gonna relax. And I'll be in the Discord throughout the rest of this afternoon. So yeah, this was don't get me wrong, this was a long stream, but I think I learned a lot from it as far as presentation wise, and I'm gonna try and cut this down tomorrow, get it back down to 10-20 minutes, do more of these short little quips with looking at these odds. Oh, wow, check that out. 70% of the time you close above that line. Oh, I will draw my line right there. Yeah, I'll keep it right there. And this is on dollar yen. Sure, let's do that. Alrighty. Everything looks good on my end. I'm going to go ahead and leave the screen blank for a little bit. Make sure that all the data got loaded into YouTube, because I have had a problem with the last two streams where not enough data got loaded for some reason, and like the last 5 minutes or 10 minutes of the stream got cut off. So thanks for watching, everybody. And I appreciate all the chat. And I'll see you guys tomorrow for the next daily plan. Alrighty. Talk to you guys in a bit.